Okay, so now we're going to move into machinery, and we were having a sidebar talking a lot of factors that are impact it, and I cut it off, so hopefully we'll be able to get into it now a little bit, and we'll go into machinery, and this is what you call a growth story. It's a nice smooth growth story. It's still consistent with what the model was before, had a little bit of waivers before. Again, if you look at it in terms of scale, those waves don't really concern me all that much, but even those have smoothed out some as we take a look at it over the next few months. And it is a pretty big increase. Over 18 months, we're looking like about 30%. So, or about 25%. So that's a pretty big increase over the next 18 months.
There have been a lot of factors at work that have been pushing machinery. We work a lot with associations that are heavy into heavy machinery and all kinds of productive capabilities in manufacturing, and they've identified 4 drivers that have really been pushing this whole industry. Number one, we've talked about in several of these, which is the move towards robotics and automation and technology. So people are using machines to replace people. It makes them more competitive on the global environment. Number two has been the fact that there's money available for capital investment. The banks have, I mean, it was recently released by the Fed that between 25 and 45% of banks have lowered their lending standards significantly in the last year or two. And they're doing this because they anticipate a point being reached where the interest rates are going to go up and they're going to have a little bit less of an opportunity to make money. So they're sort of trying to make money while they can, and they know that loose money policy days are numbered. But it also means that companies that are trying to buy machinery are finding very responsive banks, because the banks are like, hey, we want to lend money anyway. Now you're giving us an opportunity to lend to a company that can capitalize that loan. So that's number two. Number three has been the fact that many of the sectors that buy machinery have been down for a while. They have not been buying machinery. Now they want to speed it up. I was just looking at the demand for agricultural equipment. It's going straight up because the farmers have not bought new stuff in quite a while, and the new machines are a lot more capable than they were. The expansion of broadband rural access has allowed those machines to find a market which they hadn't for the last several years. And then the fourth thing that's really driving the machinery wagon at this point is that you've got a lot of companies that are trying to compensate for that supply chain interruption by doing more production at home, and that's causing them to buy more machines. So most everything you can think of is really favoring the big machine tool makers, and whether it's in the mining sector or the industrial manufacturing sector or ag, they're all seeing that same kind of growth.
Yeah, not much to add there. Supply chain and logistics would be one other area where you see tremendous amount of investment in intermodal facilities, terminals, warehousing, where you get a tremendous amount of new sophisticated machinery being added into the mix. So those are just other drivers, I think, on top of everything that Chris said.
And so in the long run, you get another case of the Loch Ness Monster type long-term thing. This has been a sector that's been really volatile and all over the map.
Mm-hmm. It's always been very dependent on a sector than some of the others. I mean, they're also dependent on it, but the access to money is critical, because you're talking about machine tool makers and machinery makers are selling to those smaller operations, those fab shops that we talked about earlier in another session. And in order for them to buy the machinery, they have to have access to that bank credit. They have to have investment dollars to work with. So the machinery people have always been caught between demand on the one side and accessibility of credit and money on the other. I mean, a lot of the machinery, we also work a lot with credit managers, and the credit managers have been noting that the machinery makers are doing everything in their power to make sure that credit is accessible, even though a lot of the companies that are asking for credit are a little weaker than the credit managers would prefer. I mean, there's an awful lot of conversation about, well, you don't really qualify for 120-day terms, but yeah, let me see what I can do.
Yeah.
You know, one thing that I was going to point out to here is that when you look at this peak that we're predicting, yeah, that's an historic high. However, if you look at that peak in perspective to where the other highs were, the other highs grew.
Mm-hmm.
So you have this high here at the end of beginning of 2008. You have this high in the beginning of 2011. You draw a straight line, and it's not too far off from the peak,
No.
from where the next high is. So it's the growth in the highs kind of follow a trend line a
Yeah.
little bit.
And I think you see a consistent pattern, because you go back to 2008, we came out of that recession. Everyone that we've shown, when we look at the 2008 recession, showed this very slow rebound that by the time you got to 2017, 2018, the one that you're seeing for machinery, that's a V. You know, that's just like what we're going through now. I mean, it's a little bit more elongated, maybe more of a U, but still a much faster rebound than we saw in industrial production overall. So machinery tends to be that, you know, when the times are good, you're buying it, and when the times are not, you're not.
Okay, and if we look at year over year, nothing jumps out at me, at least up and through, because the year over year only counts through the end of 2021, and there's nothing out of bounds here when you're looking at it. It's trending. It's trending. In fact, it looks a little bit like 2017. Keith, you brought up 2017 and a couple other arguments before.
Yeah, absolutely. Yeah, it looks like it's trending second strongest year in what, 7 or 8 years there. So, so it's good growth.
All right.
Very good.